So is the stock market a real path to building wealth, or is it just one giant casino? It's a huge question, right? And honestly, it's what keeps a lot of people from ever getting started. In this explainer, we're going to cut through all that noise and give you the tools to actually tell the difference.
And let's just be real for a second. This quote hits on the exact fear that holds so many of us back. You hop on social media, you see all this hype, you hear about these so-called gurus, and it's overwhelming. The idea of losing your savings, that's a completely valid concern.
Which brings us right back to the big question. Are you just rolling the dice every time you buy a stock, or is there a way to make this a disciplined strategy for building actual long-term wealth? Well, the answer really comes down to how you approach it. Okay, so before you put a single penny into the market, this is rule number 1. Seriously, think of the money you start with not as a bet you're hoping to win, but as tuition. You're paying to get an education in how the market works. Once you get a feel for it, then you can think about scaling up.
This slide just lays it out so perfectly. It's all about your mindset. On one hand, you have the sprint. The goal is to get rich quick, turn 100 grand into 300 in a few months. That's not investing, folks. That's just betting. The right mindset is the marathon. You're focused on slow, steady, sustainable growth over years. That's where the magic really happens.
I absolutely love this analogy because it's so true. You wouldn't just jump into a car and hit the gas without knowing which pedal is the brake, right? Well, the market is exactly the same. So let's learn what the pedals do. We're going to look at the key numbers every investor really needs to get a handle on.
First up, we've got EPS, which stands for earnings per share. This one's a big deal. Basically, it tells you how much profit a company is making for every single share of its stock out there. Simple, right? A higher EPS usually means a more profitable company, and that's exactly what we're looking for.
Next is NAV, or net asset value. You can think of this as the company's book value. Like if the company decided to sell off everything it owns, its buildings, its equipment, everything, and then paid off all its debts, the money left over would be its net asset value. It's a great way to understand what a company is fundamentally worth.
Now, the PE ratio is super important because it connects the stock's price to what the company is actually earning. Let's say a stock is $100 a share and its EPS is $5. That gives it a PE ratio of 20. Now, a really high PE could mean investors are expecting huge growth, or it could mean the stock is just way overpriced. This number helps you ask that simple, crucial question: am I paying a fair price here?
And this is what gets a lot of investors excited: dividend yield. This tells you how much cash a company pays out to its shareholders each year compared to its stock price. This is your reward for owning a piece of the company, a potential stream of, you guessed it, passive income.
Okay, so now we've got some tools to figure out what a company is worth, but what about when to buy or sell? And maybe more importantly, how do you protect yourself from big losses? Let's check out a couple of tools that can really help with that. This is the RSI, or Relative Strength Index. It's a tool that helps you gauge a stock's momentum. Think of it like a little meter that tells you if a stock might be overbought, meaning its price went up way too fast and it might be due for a drop, or oversold, which could signal that it's a potential bargain. Now this might just be the most important tool for any new investor. A stop loss is basically an automatic sell order. You set it at a price below which you paid, and if the stock happens to drop to that price, your shares are sold automatically. It limits your losses. It is your financial safety net, and it's non-negotiable. So here they all are, side by side. This table is a great cheat sheet. Look, nobody can predict the absolute top or bottom of the market, but when you understand these numbers, EPS, NAV, PE, and DY, they act like your compass. You can navigate with some real confidence instead of just taking a wild guess. At this point, you might be thinking, well, why not just stick my money in a safe, fixed deposit at the bank? And you know what? That's a fair question. But with that safety comes a hard cap on your growth. A good growth stock, on the other hand, gives you the chance for what our source calls a double win. And here's exactly what that double win looks like.
With a fixed deposit, you get one thing: your guaranteed interest. But with a solid stock, you can get dividend payments, which might already be better than the bank's rate. Plus, you get the capital gain if the stock's price goes up over time. Two potential streams of return instead of one.
But wait, you say, what about market crashes? Yeah, they happen. That's a fact of life. But here's the thing. When you zoom out and look at the big picture, over 5 or 10 years, a very clear pattern shows up. The market dips, but it always finds a way to recover. And more often than not, it bounces back even higher than before. The long-term trend is up.
And that really brings us to the single most important idea in all of this. The mindset, the tools, the strategy, it all boils down to this one simple truth. Your best defense against risk isn't some guru or a hot stock tip from a friend. It's doing your own homework. It's knowledge.
So we've talked about the right mindset, the key numbers to look at, and the long-term strategy. We've laid out the clear difference between betting your money and actually investing it. You now have the compass you need to navigate the market with a real purpose. The only question left is, where are you going to begin your journey?